Hello everyone and welcome to this week's live stream. So this is a special PMS live stream. The PMS, the Wright PMS has completed 5 months and it's been a very exciting 5 months. So me and Siddharth are going to take you through our performance, what we are seeing in the markets and what is the outlook. If you guys are interested into the PMS, please go over to our website and drop your interest out there. Write to us at pms.sales@wrightresearch.in and we'd love to have a chat with you. So we have a very quick presentation that we will go through. Um, so this is about the PMS and about our outlook with the market, right? So, firstly, let us talk about what's happened in the last 5 months. 5 months have been extremely exciting. Me and Siddharth have talked to so many people. We've got more than 100 folks who are live with us right now, and another pipeline of around 70, 80 people who are in the process. We have close to 70 crores, which is deployed in the last 5 months. Our strategies have done incredibly well, right? So if you track PMSs, you would see that Right Alpha Fund ranked as the top PMS in terms of performance in 2000 in November 2023. That PMS till now, that scheme till now has been a 36.3% return in 4.5 months, which is 20.2% over the benchmark. Our flagship Right Factor Fund has given a 34% return in last 5 months, and it is 16.5 over the benchmark. And also our third scheme, which is the Right, which was previously called Right Factor Fund Hedged, is something that we have renamed to Right Momentum Fund Hedged to bring in more clarity to the investors that it is much more of a momentum investing plus hedging. So that one also has done well and has outperformed the benchmark by 5.3%. And we're very excited to share, what's been happening in these products, what's the allocation, and why the performance has been like this, and what is our outlook on the market. So firstly, let's look at the Right Factor Fund. Like I said, this one ranked among the top 10 best performing PMSs in the last month, in the month of December. So in the month of December, Right Factor Fund gave close to 10% in terms of returns, outperformed a bunch of other PMSs. And why is this exciting to us is because last month was the month when large caps did better than mid cap and small caps. Traditionally, our allocation is flexi cap, but even in a month when the large caps did well, our PMS has ranked among the top 10. And that performance is continuing in January. You can see this uptick that has formed in January, and the performance has been strong. And across all the 6 monthly chart that you see here on your screen, you would see that the PMS has always outperformed the benchmark, be it in a good month or in a risky month, right? So that was about the Right Factor Fund performance. Right now, if you look at the allocation, something very strange will be visible, which is that large cap stocks have suddenly become the majority in Right Factor Fund. Now that's very strange because we started with a lot of small and mid caps, and now we have majority large caps. Even though we haven't churned a lot, right? We haven't sold those small and mid caps. So interestingly, what has happened is that the stocks that we bought 6 months ago, which were categorized as small and mid caps, have rallied a lot, right? So stock with let's say 3,000 market cap has rallied, 100 or 60, 70%, crossed the 500,000 threshold to become a mid cap. A stock that had larger was a mid cap has now rallied to cross the 20,000 crores, above which a stock gets categorized as large cap, right? So a lot of the stocks in our portfolio have automatically become large and mid caps. You can see it's again highly diverse, but there is a lot of cyclical exposure in our portfolio. So okay, we have large and mid caps, but the exposure is still towards the cyclical sectors, towards power finance, towards infrastructure. There is some metals, oil and gas exposure as well. even though it is well balanced with pharmaceuticals, your FMCG, IT, and finance as well, right? So it's a very well diversified exposure that this fund has, and which is why even in a month when large caps rallied, this one outperformed. Let's talk about our second fund, which is again a very popular one, and this is the Wright Alpha Fund. Right Alpha Fund is only a 10 stock portfolio, right? And with these 10 stocks, you are picking the high momentum stocks among these 10 stocks also. Now, what you would see is November was an incredible month for Right Alpha Fund. It beat the benchmark by a margin. But in December, there was a lag with this fund because, these high momentum small caps did not perform very sharply in December. And like I said, largely large caps did better. But what you will see is in January again, this fund is back with a bang and it has done more than 5% already in this month of January. So I think it's a very interesting time for Right Alpha Fund as well. And it is the best performing PMS, even though it started like a week later than Right Factor Fund. This one has given 36.5% return and a 20% outperformance over the benchmarks. But yes, like we say, that this is a highly concentrated momentum strategy. So it is a high risk, high return. It is not moderate risk. It's a high risk, high return strategy. Can give you very sharp return, but will also have, relatively high risk in riskier times. If you look at the holdings for Right Alpha Fund, again, the same thing has happened that, okay, while we added a couple of larger stocks, again, in the infrastructure space in the last rebalance, this scheme has also become large cap majority in a sense because a lot of the railway, power finance, and all of those companies which have rallied a lot, some of the capital market names, shipbuilding, engineering, these stocks have rallied a lot that now they are categorized as large caps. The definition for large caps is that any stock that is above 20,000 crores in market cap is a large cap, and these stocks have been upgraded to that due to the rally. And again, but even still, you will see that it's a very diversified exposure with 10 odd stocks. They are, all the 10 are coming from 10 different industries, right? So while it is concentrated and high momentum, it is extremely diversified across sectors as well, right? Now coming to the Right Momentum Fund, the newly named Right Momentum Fund. This is our momentum strategy, which is hedged. Previously, we used to call it Right Factor Fund Hedge, but to avoid the confusion, we're calling it by the more correct name, which is Right Momentum Fund Hedge. And you will see that while this one has lagged a little bit, the other funds obviously it has outperformed the market, right? It has a 5% outperformance over the market. But yes, in the month of January, it is picking up very nicely, and you can see that the outperformance has been built up in the month of January. It's close to 5%. Let's look at the allocation here. Again, the large and mid caps have become highly good and a high exposure. And if you look at the exposure to different sectors also, it's highly diversified. Engineering, railway have a good allocation. IT has a decent allocation in this fund. Electrical equipments, auto ancillary, all of these interesting sectors have allocation in the momentum fund. And we are sort of expecting it to come back and give the performance that we expect out of it. It's only been a small 5 months, but we expect this fund to also pick up. Now, so that was all about the funds, and please do drop in any questions or confusion or anything that you need to know about our three PMS products. I've very quickly taken you through it uh, to give you a very brief, summary of what these funds are about. Right Factor Fund is a multi-factor fund, so we're looking at factors in the market like momentum, like value, like growth, like quality, and allocating to them. So based on the market condition, it's highly risk averse. I mean, it is moderate risk, and we would deallocate to gold and bond in riskier times, and it's highly risk managed. The second fund, the Right Momentum Fund, which is hedged, it has only the momentum factors, but it is diversified 20 stocks. It is a moderate risk strategy. It is also hedged by buying put options in risky times. So this is the second strategy, and the third strategy is the Right Alpha Fund, which is 10 stocks highly concentrated. And because of the high concentration on these high momentum stocks, you can expect a sharp return as well as higher risk than the other funds, right? So these are the three equity products that we offer under the Right PMS. Let's look at what are the expectations that are coming out from the market quickly before we go over to the Q&A. And I don't want to take a lot of time going through this, but we'll quickly cover what are the expectations coming out from the market. So the first expectation, first thing to look at is, what are the key factors that are driving the market just before the earnings season, right? I think what's the biggest factor that is out there, the biggest thing that people are watching is the potential rate cut that might happen in the market, right? So if you look at the market cycle, you would see, if you look at the Fed commentary and all the expert commentary, you would see that everybody is expecting the rates to moderate, in 2024, rates to be cut across the globe. And if that happens, that could boost the liquidity into the system, right? There will be more money circulating into the system when the rates are cut, and that will boost growth in the economy. That will bring in more money from developed markets to emerging markets like India, which can show growth. And there we are seeing an impact on global equities and 10-year government yields already. So this is one big event to watch out for. Second big event that people are expecting is political continuity in India, due to the state elections that went really well for the current ruling party. People expect that government to continue, and that will build up to the policy momentum. So because the current government has done a lot of reforms in the manufacturing segment, which has led to a rally in those stocks, people expect that momentum to continue as the policy continues. That's the expectation. But obviously, elections are a high risk event, and we have to be very careful in the run up to elections, right? Now, the third important factor to note is institutional flows. We can see that both DIIs and FIIs are pumping money to the India market right now. Last year, we saw $44 billion being, you know, pushed into the public market, which was a record high. And the culture among domestic institutions, domestic retail, is building towards equity investment, which is much needed in India, because India is a traditionally very small, it has very small penetration of equity investing. So it's very exciting that people are now looking at equities as a way to invest and way to save. And that's the culture being built, and that's what is also leading to growth of the Indian market. And then obviously the macroeconomic scenario and the strong corporate earnings are also coming and supporting this sustained inflows that are coming from institutional investors. Now the second thing is, let's talk about last year. We haven't talked about last year in a live stream yet. So last year was an amazing year. We saw all the larger indices show amazing multiples, right? Mid caps, small caps outperform the Nifty by a big margin, right? And last year was a year of small and mid caps, whereas people are saying that the valuations could be hit and there could be interest from in large caps as FIIs put in money. But we do expect small and mid cap sector to be extremely strong as well. If you look at 5-year basis, Nifty CAGR has been 15%, and Nifty mid cap has been around 21%, whereas small cap is around 19%. We saw amazing run-ups, very exciting themes play out in the last year. Uh, Sectors that have traditionally underperformed in the past decade were the winners in the recent market rally. So from real estate to capital goods to auto, infra, healthcare, PSU banks, industrials, defense, these stocks have traditionally been underperformers and they have become gainers in the recent rally. So, real estate was the best performing sector. It rallied 81% in the last year. Capital goods rallied 67%. Autos rallied 48%. Infra 39%. And these were the most favored sectors in the last year, which have led to big growth. And obviously, small and mid cap stocks in these sectors have been the outperformers. If you look at the earning growth, you would see that Nifty has recorded a 30% earning growth. in the first half of 2024. Uh, I mean, Nifty is expected to record a growth of 30%. If you look at the high frequency data, right, you would see that there is a continued earning momentum that people are expecting in this quarter. And again, people expect automobile, real estate, capital good infrastructure, industrials to stage a good recovery. Let's look at what are the concerns that are there in the market. So obviously, in the current market, a favorable macroeconomics, robust capital inflow, and growth story are the big themes that are playing out. But there are potential challenges as well, right? Obviously, no journey in the equity market can be linear. There will be bouts of volatility that will be expected, right? So any correction of 5%, 10% cannot be ruled out, because markets are dependent on a number of factors. There could be geopolitical concerns, there could be just valuation sell-offs. China could stage a recovery, and money could flow there, and there are a bunch of things that could happen. But it's all very organic, and the longer term theme remains very strong. So bouts of volatility are part of the process, but I think the long term story and the long term path for Indian market remains very, very positive, and it seems to be a great opportunity for us to invest into a high performing PMS or a selected equity product in this market. Obviously, another concern that could happen could be on the commodity prices, on the upcoming election in India and the US. Obviously, the wars going on in the world in Ukraine and Israel could also have an impact, right? In terms of portfolio strategy, I think allocating to the growth and emphasizing on the cyclical stocks at reasonable valuation. Let's not go insane with the valuation that these stocks are commanding, but at reasonable valuation, betting on cyclicals and the growth story would be a great strategy, right? Now let's do a quick preview on the earning season. What are the expectations of the upcoming earning season? I think we've already seen the IT stock earnings, right? And IT stocks have all been given very muted earnings, but still have seen crazy amount of buying happening, and that's been a very strange phenomena. But I think technology earnings, what they are telling us is that these stocks, despite all of this trouble in the world, have remained stable and resilient. So they do have the power to stay put and persevere through hard times. And now that the things are getting better, people expect that upcoming quarter could in fact be a quarter for IT where you see deal wins happening. The expectations from the next quarter are very strong, and because markets work on expectation, people are buying into the tech sector right now. Apart from the tech sector, we expect auto to give very strong earnings, much like previous few quarters. So this is the seventh quarter of margin expansion in the auto segment, and we are expecting, while the private vehicles have done well, we are expecting two wheelers to also come out with strong performance in this quarter. If you look at banking and financial, again, it's going to be a great quarter for banks, and this is primarily a good quarter driven by credit growth, right? So the credit markets have seen a very strong growth in the economy, and that would lead to good numbers coming out of banks, NBFCs, and public sector banks. We also expect a healthy earning outlook from the oil and gas segment, with improvements in GRMs for the OMCs, and oil and gas is expected to have 18% of incremental growth. Metals are expected to show a 25% growth, and it's going to be a decent quarter for the metal segment as well. Technology, we did talk about technology, while it has shown muted growth, weak growth, but there has been uh, a big interest in the segment, not just from Indian investors but also from FIIs, because they think that that technology could be a great way to look at. Technology is going to see a great resurgence. Specialty chemicals, will show a decline. Similarly, cements are not going to put very good numbers out there. So there will be certain muted segments also, but good numbers expected out of auto, banking, financials, oil and gas, metals, etc. Right. So the overall picture, if you look at the third quarter of 24, people expect earnings to grow by 10%. PAT to grow by 10%, EBITDA to grow by 10%. Sales forecast is 4% YOY growth and 11% if you exclude metals and oil and gas. Earning margins are expected to expand in several sectors: cement, oil and gas, automobile, retail, capital goods, etc. And Nifty earnings are expected to grow 10%. And the key drivers in the large cap Nifty universe will be HDFC Bank, Tata Steel, Reliance, ICICI Bank, and JSW Steel. And if you look at the expected growth in the next year, people expect 22% year on year earning growth, which is quite good for the country. And, I think that's going to lead to a strong growth in the domestic equities market as well, right? So that was all about the PMS and the markets. Let's quickly go over to the audience questions. Siddharth is here, and let's
Yes,
let's cover a few questions from the audience, Siddharth.
absolutely. Good morning, everybody, and thank you for the presentation, Sonam. So, we have a lot of questions pouring in, right? And
Mm-hmm.
the question that people are asking, or the audience is asking, that is there any plan to introduce a hedge version to Alpha Prime in the PMS side? And if so, what will be the overall strategy for that?
Yes, so Siddharth, like we always tell our clients that we will be hedging the alpha strategy as well, right?
Hmm.
But and it is totally dependent on the client, right? If certain clients don't want derivative exposure, then we won't hedge it. But the
Right.
plan is to hedge the alpha strategy also, or any other. Even if you want to hedge the factor strategy, we're very happy to do that on a client on
Hmm.
client basis, right? And the
Right.
strategy for hedging, I've been doing a lot of research on the hedging part recently, and see, the strategy there is it's very simple, right? Depending on the amount of correction that we're seeing in the strategy and the VIX levels, right? What is the volatility level in the market, right? If the VIX is very low, then buying option will not be very beneficial for you, right? Only when the volatility is rising, only then will your hedge deliver something. So when we see
Right.
a heightened volatility, and when we see slight correction happening in the strategy, we buy put options. And again, there's a lot of research that we do on what is the expiry and what is the strike price on which you have to buy. And we have a good strategy in place that provides like a very insurance like hedge, right? In a normal market it will give you nothing, right? It might not be deployed in a normal market when the VIX levels are
Hmm.
low, but when the
Right.
is high and when the volatility is high, then it will give you just that insurance that if the market
Right.
crashes, it works for you.
Right. Uh, Perfect. So we are getting this question again from a lot of investors, right? How can an investor sort of manage the FOMO during the bull market that we are seeing and avoid,
Mhm.
potential market bubbles, right? Any
Mhm.
psychological tip that you could share on, how to stay calm during this bull run? And is this the right time to invest as well?
No, definitely. So that we get this question a lot, right? I
Hmm.
think
Of course.
every
Of course.
investor asks us this
Yeah.
question. And
Yeah.
see, I think when we talk about our strategies, what we tell them is that we are extremely aware of risk, right?
Hmm.
And the moment we see that there is a situation where there could be persistent high risk in the market, you would see
Hmm.
that our strategies will shift towards safer allocation. You will see a lot of low risk stocks coming in. You will see, hedges like gold and bond coming, or sometimes actual hedging happening in these strategies. So we're
Right.
extremely aware about the risk. And while the market is giving us the opportunity, right, there is a strong opportunity, right? And that's not just us saying, that's all the experts across the board who are saying that in the
Hmm.
India market. So why not take advantage of that and be allocated into the market? I think any correction that people are seeing right now could be of the amount of 5%, 10%. Uh, and that's a very minor blip in the equity market, but the potential upside that is there in the long term is way bigger, right? So
Right.
many of our investors, even when we started, were averse about it. Should we allocate or not? 5 months. At 5 months, if you didn't invest, you missed out on 38%, 36% upside, right? So I
Hmm.
definitely understand that people are concerned about valuations, but you have to look at it from the holistic level. I think Nifty is not overvalued right now, but yes, certain pockets are looking overvalued. But that too, if you look at the earning momentum, or how strongly the earnings have been growing, uh, the infrastructure segment, the cyclical segment, is not overvalued. It is in fact
Right.
growing at a decent valuation, and with the prospects that are looking very strong, we can have a strong bet in those segments as well, right?
Right.
So I think we
Right.
have to
That,
be
that's
aware
fair.
of, yeah. Yeah.
That is fair. We have another question. People want to understand, why should somebody invest in a quant fund versus just investing in the index directly?
See, I think uh, quant funds definitely will give you a lot of differentiation from the index, because typically how an index is formed, to give you an example, see, if a Nifty or large or mid cap index is just the top stocks based on market caps, right? So
Hmm.
it is highly passive. It is not looking at opportunities within the pockets, right? If you're investing into, let's
Right.
say, small and mid caps, and you invest in the top 100 only, then you would have picked up the opportunities that came up in defense and railways and power finance last year, right? Because those
Right.
were pockets that were hidden, right? They were not the top stocks. So you would have missed out on that. So obviously, being active and picking up stocks has an advantage over, I mean, we believe has an advantage over passive, and that's what we've shown in the last 4.5 years.
Yes.
Yeah. So definitely
Yes.
that has an advantage, and even if you look at any of the momentum indices or value indices, etc., that NSE publishes, even
Hmm.
those are extremely passive if you compare to any of the strategies that we offer. Like those are also
Right.
rebalanced on a quarterly, 6 monthly basis. They only look at top 200 stocks on the Nifty. So I think our strategies add a lot of differentiation over those indices also.
Right. Right.
Yeah.
Perfect. The audience wants to know a little more about the PMS schemes, right? If they can switch between the schemes as well, and also on the fee structure part.
Yes, Siddharth. So do you want to take that?
Yeah, yeah, absolutely. Why not? So, yeah, switching between the schemes is possible. In fact, a combination can be created, right? Given that a lot of investors are worried about, the market being at the top, or there might be some, sort of froth in the market itself. So, yes, a combination and switching between schemes is definitely possible. Talking about fee structures, we have three structures. The first one is a flat fee AUM based. The second one is a hurdle rate of 10% with 10% profit sharing, and the third one is a very interesting fee structure, because we all love talking about the markets beating the benchmark and the indexes. So we decided to, keep a variable hurdle, where the benchmark BSC 500 itself becomes the hurdle, and anything above and beyond that would attract a profit sharing. So anybody who has more doubts on this can reach out to us, and we'll be happy to discuss on that, right? Um, Sonam, the next question is, more on the allocation or the composition of allocation when it comes to PMS schemes. Do we
Hmm.
have exposure to, debt funds, to gilt funds, right?
Yeah. Yes. So like Siddharth, you told that we can allocate to different combinations, right? So we have a debt fund also, debt PMS, right? In fact, which has number of debt mutual funds only,
Mhm.
right? Now people can choose to have a mixture of these schemes, like you said, right? So if somebody is looking at a low risk exposure, we can give them some allocation to debt and some allocation to equity, alpha, etc., right?
Right,
Depending on your risk profile, we can create a customized basket for you. In our equity baskets, debt and gold, they will also occasionally pop up, right? When the market is turning in favor of gold or turning in favor of debt, you will see those ETFs start popping up into the strategy. But normally, the strategy would be more of a equity strategy.
right, right. I think that's perfect. So given the expected volatility that we might be expecting, Sonam, so in that case, would it be advisable for an investor to take a SIP approach or a lump sum approach to investing?
Yeah, I think that's again a very interesting question. See, with PMS, you have to start with 50, but even with that 50, what you can give us is specific instruction to deploy it in a systematic fashion. Start with, let's say, half of it, or or one fourth of it, and
Mhm.
rest of the money you can deploy as a SIP, or you can, if the market is volatile, right? So typically, if we see the market is favorable, we like to deploy on day one, because that's when you get the return potential out of it. But yes, if the market is looking volatile, right, which will happen in the future, what we would do is we do not deploy all the money on day one. We would deploy, let's say we have 20 stocks, right? And there is we think that subsection of the portfolio is going to be rebalanced in the upcoming weeks. So we will not invest into that portion of the portfolio. We just invest into the stocks that are going to stay, and we will deploy rest of the money as the rebalances happen, right, as stocks come and go into the strategy itself, right? So
Right.
that is what the strategy is in a typical market. And we're very happy to have a discussion on a client on client basis on how they want their allocation to go, and form a consensus with the client on how we should deploy.
Yes, absolutely, absolutely. We are always happy to have that conversation, and anybody who wants to reach out to us, you can just write us an email, and we'll get in touch with you. Uh,
Siddharth, I think I've lost you. Can you hear me? I think I've lost the audio for you. Um, will you try to reconnect your audio, so that please? In the meantime, I'll just pick up a few questions from the stream. I think somebody is asking me some good books to learn about P ratio and fundamental of companies that they wish to study. So, see, I'll tell you where I studied all of this. I think for me, doing the CFA level one, level two courses, I think that was one of the best way for me to learn about these ratios, and how to value companies, valuation methodology, etc. So I think you can have a look at that. And along with it, now there's so many other resources out there in the market. So when I was studying, more than 10 years ago, there were little resources, but now there's so many resources out there on the, you can find a YouTube video that will explain it perfectly. And you will find so many other resources on the internet. Let's just check if Siddharth is back. Oh, Siddharth, I think I still can't hear you. Let me just try to refresh my thing if I am having a problem.
am I audible now?
Yes, Siddharth, can you hear me?
Yes, I can hear you. Can you
You
hear
can.
me?
Yes, I can. Okay, then there might be a problem at my side. Yeah, so let's go on with the questions.
No problem. Yes. So a lot of investors wanted to understand the difference between investing in a small case of ours versus a PMS, and versus a mutual fund as well.
Yeah, yeah. So I think, see, they are all unique products, but all everybody is investing into equities, right? Small case is more like a direct equity solution. PMS is also direct equity solution, but there you get a professional manager who's managing everything for you. So small case is more like something run by research analysts or investment advisors, where we give you our allocations, and the small case platforms makes it very easy for you to follow along. Whereas in PMS, we in fact manage everything for you, right?
Right.
Obviously, the shares in all of these strategies stay in your demat. This is your money which is allocated in your demat. We have the right to manage it in the PMS structure. Uh, and yeah, I think there's a difference between small case and PMS. What we have observed is that we can do better execution strategies, get better prices by by strategizing how to participate into the market. We can take that decision on when to on when to put in money and when to sell much more actively compared to small case, where we have to communicate it to the client and they have to follow a schedule. So I think those are some of the things that are different for the PMS. And with PMS, we don't have to follow a schedule for rebalance. We can do anytime we want and act a little bit more fast in riskier times. A mutual
Right.
fund, on the other hand, is a different product altogether. It is managed by a professional manager, but the mutual fund tend to have larger capital sizes and large and bigger constraints on them. So you know a flexi cap that we would have could in fact go as much into small caps, mid cap, large caps as we want. We can go to any sort of sectors or industries, whereas mutual funds would have more constraints that would restrict them to participate in different ways.
Right. Right. And
Hmm.
I think that's fair. So, Sonam, given the expected volatility that we might see in the markets, right? How do we plan to manage risk, especially for the PMS?
Yes. See, I think the different risk management philosophies, right, that Wright Research has. So, if you remember the chart that I showed you for the alpha strategy, right, in fact, it's a 10 stock portfolio and it has 10 different industries, 10 different sectors, right? So, it's all of our strategies, the construction methodology of all the portfolios. It's not just about picking top momentum stocks, right? That is not the criteria. It's always pick the top momentum stocks that will give you the lowest risk, right? So when you try to reduce the risk, what the strategy ends up doing is ends up diversifying away the risk, right? So if I have a stock in FMCG segment and an infrastructure segment, these will both square off the risk that they have, right? Make a much more diverse strategy. So diversification is the first thing that we do. Second thing that we do is the regime model, right? Predicting the markets are cyclical, like market goes through up cycle and they go through a down cycle also, right? So we try to forecast when the cycle is going to turn. And when the cycle turns, you will see that our strategies will become some of the lowest risk strategies out there in the market, because we reduce the risk budgets, we go into safer assets, and we try to uh, you know uh, reduce the risk exposure. So that is the second level of risk. There we would sometimes move to gold, bonds, sometimes we move to slightly safer stocks. And then you have the final thing, which is deallocation policy. When there is very high risk, then we will reduce exposure to equities, move to cash systematically, and that will be another level of risk management, right?
Right. Perfect. Does any of our PMS schemes right now has exposure to US equities? If not, do we plan to do it in the future?
Um, no, I don't think any of the schemes right now has exposure to US equities, but what we are thinking about is creating like a multi-asset portfolio at a lower risk, which includes, US equities and other asset classes as well. But we don't have anything right now,
Right. Right. But very soon, once we have a structure, I think we'll be happy to, share a portfolio on that part as well.
right?
Right. Yes. So more or less, we've answered all the questions. Just one or two questions, towards the end. People are asking, some good books that you could recommend them, right? And what you're reading as well. They want to know.
Yes, so the number of interesting books in about the stock market and that you can have a look at. I like to read about people's journey in the investing philosophy, in the investing field. So I've recently read I read Jim Simon's book, which was really inspiring for me. I've read a book about Ray Dalio recently, which I just finished, and so this always gives me a lot of insights into the journey that these folks have had into building these large investment funds. And if you want to look at the market, I've also read recently a book by Manoj Parbai, which is The Dhando Investor. It has a lot of very interesting insights on into how these different communities have built their wealth and what it means to get high returns at a low risk. So it's been very interesting to read about that.
Right.
Um, yeah.
Right. Right. Uh, Perfect. Right. Yes. Another question. Is there any net worth to invest in a PMS? Is there anything defined like that? Some people are asking.
So there's no net worth criteria as such, right? But you have to minimum is 50 lakh, right? So you have to have 50 lakh rupees to invest, right?
Yes. And also, I would like to add, not only individuals but private limited HUF accounts can also be opened, right? So anybody who wants to open it in that structure and invest with us, that's definitely possible. Uh, so more or
Exactly.
less, we've yeah, yes. You were
NRIs
saying
as well,
something?
right? I'm saying NRIs can also invest, right?
Oh yes, absolutely. Even NRIs can invest, right?
Yeah.
So we have that structure also sorted. More or less, we've answered all the questions that were there, Sonam. Yes,
Perfect, perfect. So I think we've had a quick discussion, and I hope people appreciated it. Like I said, if you want to reach out to us, please go over to the PMS website. You'll find a small form where you can put in your details. You'll be given a call by the team, or you can book a call with us through the calendar link, and then there's a email on your screens, pms.sales@rightresearch.in. You can just write to us over there, and we'll get in touch. So
yes.
perfect. So thanks a lot, everybody, for joining. It was, again, I love talking, coming back every month, talking about the performance of the PMS. I hope this momentum continues, right? And yeah,
Absolutely. Yeah, I mean, thank you everybody for, taking out the time on a Sunday morning to, listen to us and understand the performance. And anybody who's interested, who has any more specific questions, the email is right there in front of you. You can reach out to us and we'll be happy to help.
thanks a lot, everybody. Have a great weekend.